Okay, good evening, everyone. We wait for a while for the rest to join us. Welcome to our 21 days challenge. Okay, today is the day number 8. Okay, we are on day number 8 of this 21 days challenge. Okay, it's both a challenge for you and both a challenge for me. Okay, so can we finish the 21 days? Okay, that is the question. Okay, so welcome. Okay, good to see everyone here. I see the usual people. Okay, Julianti, Bo King, and Derek, Sweet Kid, Raymond. Thanks, Gabriel. Okay, good to see everyone here. Okay, so today is a day number 8. Okay, so wow, after 8 days of trading, I mean, coming out with content is no problem for me, but it's really having the discipline to keep doing this. Okay, because there are things that I want to share. Okay, but I think the challenge is really coming out having the time to do it, because I have some other things that I'm doing as well. Okay, so welcome again. Okay, good to see everyone here. Archer, Raymond, okay, all the usual faces. Okay, good to see everyone here. Okay, as usual, our disclaimer, as Sheldon mentioned already, right? So whatever I share with you all is for education purpose. It's not advice to buy and sell. If you all agree, please type yes. Just now my Wi-Fi was not good. Okay, so later I don't know whether they have any challenge or not. Okay, so if you agree, type yes, please. Can you hear my voice? Can I? Okay. So let's get started. Okay, today, interesting topic for graduates. Maybe it's a bit of refresher, or maybe not. Okay, but for people who are new, hope this can add value for you. Okay, so there are talks about fixed income. Okay, if you put money in the CPF, if you put money in the fixed deposit, if you put money in corporate bonds, if you put money in government bonds, okay, is it better that if you leave it in the stock market? Okay, so today our question is this question, okay, whether it's better to put money in the bond market, or whether it's better to or fixed income, or better put money in the stock market. Okay, so let's set some context first. Okay, the context is these are investment money. Okay, these are money that you are using it for investment. Do not invest your last dollar, or this is your money that you need to survive into stock market or even into bonds. Okay, that's not wise. Okay, so maybe just to give you so what I want to do today is, first we want to define, okay, what is S&P index. We want to define what is the bonds. Okay, then later part we will talk about the returns, okay, on the S&P index versus the bonds. We'll talk about the volatility versus the ETF and the bonds. And then lastly is we're going to talk about, so what are you going to do about it? What are you going to do about this situation? Okay, so definition, the actual returns, and then the action point. Okay, booking, you need to find out why yours don't sound. Everybody can hear. Okay, so okay, I think we wait for, can hear? That should have sound. Okay, it's the same. Okay, so I think majority of the people can hear. Okay, so now let's get started. Okay, first part is let's define, okay, what is the S&P index. Okay, so this one, I think you all know, right? I don't do any original content. Everything I put on the internet, but I hope that the training is from a layman perspective. Okay, it's from a layman perspective. I do not want to make it too complicated so that you all do not understand. Okay, of course, I can be very technical. I can go into the jargons and things like that. So, but that's not my intention. My intention is to make everything simple, and at the end of the day, understand, and then at the end of the day, you can take action. Correct? You are able to take action on it. Okay, I think that's my main point. Okay, bringing investing and trading to become simple to understand. Okay, so first thing first, let's define the bonds. Okay, bonds basically is like lending money to the company. Let's say, example, I have I'm a company, okay, and I'm gonna issue a bond. Basically, it's like an IOU. Okay, I can issue to public. I can issue to public. So then they can lend me the money. Okay, so when they lend me the money, it's called a bond. Okay, so in a bond, usually what we have is a coupon. Okay, so a coupon rate is something that we say, okay, if you lend me this money every year, I'll pay you this amount of coupon. Okay, and then on top of that, there is also expiry. That means there's a period of time when then they can redeem. Okay, so there's an end of the bond where they can fully redeem the bond. Okay, so you lend the money for how many years? Okay, and then after you lend the money for how many years, every year they promise to give you a certain percentage of a certain coupon, and then there's expiry or redeem of this coupon. Okay, so bonds are also traded. Okay, bonds are traded in the bond market also, but bonds, right, is not so transparent. Okay, so you cannot just go to a broker and say, "I'll buy bonds." Okay, where is your platform? You know, they don't have this platform. So if you buy a bond from if I'm talking about corporate bond, right? Here, corporate bond you can either buy from a broker. So then a broker will call the desk and they say, "Hey, what is the price for, let's say, a CapitaLand? Okay, which year, which year one? Okay, then from there they can quote you the price. Okay, and then from the price they can also calculate what is the year to maturity. Okay, so in bonds, right, usually it's a fixed price. Let's say $100 is the fixed price. Okay, then this bond is traded in the bond market. So if the bond price drop, right, if the bond price drop because it's traded in the market, right, so if the bond price drop, then your yield will go up because the coupon is the same. Okay, because the amount you pay every year is the same. So your bond price go down. So what happens is your yield will actually go up. So question is, why will bond price go down? Sometimes people are not confident of the company. So people are willing to sell at lower than the 100, okay, which is standard. So then from there, the bond is traded. So at the end of the period, they're supposed to return you back the 100, okay, the $100 or the 100 amount. Okay, so that is how bond work. Okay, and then we talk about government bond. Nowadays you can trade using, I think, Poem's platform. There are you can actually trade government bonds. Okay, they are in the bond site website. Okay, but bond the return is so low, no point trading. Okay, so there's government bond, then the corporate bond, then of course we have bond fund. Okay, bond fund is basically like a fund, okay, where they buy different bonds. Okay, when they buy different bonds. So I think last time Philip has a bond, so they will buy corporate bond from different all the corporate bond and put into a fund. Okay, then the manager will manage this bond, so they have a diversification of risk, and then from there every year they will pay you based on the fund returns. Okay, based on the fund returns. Okay, so these are the few way of bonds. Okay, any question? No question type no. Why every time got people angry with me? Hershey Rupawala. Okay, never mind. Okay, any question about bond? No question type no. Any question on bonds? Okay, there's a place in bonds. Later I'll share with you where is that place in bonds. Okay, so bonds usually is opaque, right? That means that you don't know the pricing one. Okay, in fact, if you call bankers, bonds usually have the ticket size is quite big. Okay, 250,000 US usually. Okay, so some, not all, but some of the bankers, when they were to give you the bond price, they may even mark up. Okay, they will mark up the bond. Okay, so they will they get the price and they mark up. Okay, so last time some of my client, right, they will go and talk to the banker, whatever, right, private bankers, and then after they call me, Colin, can you quote me at this price? Because for me, I don't mark up. I say whatever I get, I give you the price. Okay, so but the thing is opaque. You don't know the price. Okay, so that's something about bonds. Okay. Yeah, you can buy bonds via Philip Capital. Okay, if you want, you can get a list of bonds. Okay, so there's a whole list of bonds that are in the market. Let's say example, Singtel. So there's Singtel, which year you to mature, which year mature one. Okay, so there are different Singtel. Okay, and then let's say CapitaLand, different bonds. Okay, so from there you can calculate what we call the yield to maturity. Okay, the yield to maturity. So as so we calculate from now, if I buy this bond and I hold it until maturity, then what is my yield every year? Do you follow what I'm saying? So it's you must check which company, which year, what kind of bond they issue. Okay, so bond will it be gone when the company default? Okay, so bond is like better off than shareholder. Okay. So shareholders, right, is like when you are talking about you are the owner of the shares, you are like the last one, shareholder, right? It means you buy stock, you're the last one. Okay, so the payment goes like that. The payments, if let's say a company default, okay, of course they will get the liquidator to come in, and then they will pay off the debt and everything. Then after that, the first is not the shareholders. Okay, shareholders is like last. Okay, so they will pay off the bond hold after they pay off the creditors and things like that. They will pay off the bond holders. Then after that, maybe the preference shares. Then last, then you stock shareholders. Do you follow what I'm saying? So bond is still earlier, but when the liquidator were to liquidate, right, most likely will not get back the $100 already. Okay, the full amount. Okay, most likely will be like the high flux, right? I don't know how much they get back. Okay. Okay, they get back a small percentage of the actual amount. Okay, and you also have to wait. Okay, you have to wait for people to come in, to either to sell away the company or do some kind of rescue, so that you have some valuation to your bond. If don't have, then you wait. Do you follow what I'm saying? It's just like a company closed down now. If company closed down now, I will sell away everything, right? I sell away everything. Then after that, then I find out what I've left. Then I pay. The company will pay first is who lend money to this company first. Correct? The one is IOU, right? So must pay first. Pay finish already, then whatever left over, then the shareholder left. This is the leftover, if there's any. Okay. So T notes and T bill, all these are the same. T bill is like, so corporate bonds is like when the corporate issue a bond. So a country can also issue a bond, note, they call note. Okay, they call it note, in this case, treasury note. Okay, same thing. Okay, so right now, then the safety, the guarantee is the company, country. Do you follow what I'm saying? Okay, so it'll be interesting to know that HDB, our HDB, right? They build our HDB also issue bond. Okay, I think PUB, I think also issue bond. Okay, so those are different kind of bond. Okay, of course, all these bonds will not be so good because they are like considered safe. Do you follow what I'm saying? They're considered safe, so their returns will not be low, they will not be higher. Okay, so think about it. Okay, if you are let's talk about insurance. Let's say you're an insurance company. Okay, so insurance company got like they have what we call a life fund. Do you follow what I'm saying? Let's say as an insurance company, you buy insurance from them, right? They will have a life fund. So they will promise at the end of 20, 30 years, they will give you a certain returns. Yes or no? Do you follow what I'm saying? They will give you a certain returns. Okay, but where they invest all this money? They invest all this money in bonds and equities. Do you follow what I'm saying? Of course, they must make more from the bond equities in order to pay you that 3% or whatever percentage. Do you follow what I'm saying? And on top of that, it's over a long period of time. Okay. So in general, I will share with you all this thing. Okay, you all can use this as a principle. The principle is like that. The principle is investment instrument, right? The more hands that touch the instrument, the more expensive it is. Okay, the more hands touch the instrument, the more expensive it is. Let's say give you an example. Let's say you talk about let's say you talk about a bond fund example. So with a bond, then we have the fund, okay, and then you have the investor, correct? So there is the bond, the company to make money, correct? Okay. Then after that, they go into instrument. Okay. Let's say example, I talk about what we call investment policies. Okay, investment policies. That means we talk about like those insurance company, they do all this investment what you call investment linked policies, right? Okay, so you have the investment, okay, then we have the person that sells you the investment, then we have the manager, then we have the company, then we have you. Do you follow what I'm saying? Or in between, maybe got the operation, then you. So the more people serve you, the more expensive it is. Does it make sense or not? The more structured it is, the more expensive it is. Okay, so in general, the principle is like that. But the thing is, when a thing is more structured, when a thing is more simple, not so difficult to understand, and very easy to buy, then likelihood it is structured already lah. Do you follow what I'm saying? Okay, like structured note and things like that. So, like example, you want to buy something, or someone go to your house, go and sign up the form for you. You must pay the guy, right? Fair, right? Oh, so then you got to pay the guy, you got to pay the fund manager, you got to pay the company, you got to pay the one processing your thing, and then you got to pay, then you get the returns. Do you follow what I'm saying? Okay, but what they invest in at the end of the day, they can invest in bonds and equities and stocks. Okay. Okay, so I spent some time on bonds already. Okay, so let's talk about index. Okay, so later part I'll talk about how to measure the performance of bonds. Just like we have S&P index, we can also have an index for bonds. So what we use is the Barclay US Aggregate Bond Index as how well the bond is doing. Okay. Okay, so this is the way of calculation. So next thing is S&P index. Okay, S&P index basically is the biggest company in US. Okay, let's say example, what is the biggest company in operating in US? Okay, so we have this index comprised of either the MA stocks and Nasdaq stocks. Okay, and someone decide what are these stocks. Someone decide what are these stocks. Okay, so in general, how they get selected into this index, they have certain criteria. They have quite a few criteria, like market cap must be above 5 billion, or must have headquarters in US, must have a number of shares, the liquidity, things like that. Okay, must have 4-quarter earnings. So there are different things that the company must have in order to qualify for the S&P index. Okay, and they rank the biggest 500 companies there. Okay, so far okay? Is it clear? If it's clear, can you type yes? Okay, so right now I want to share with you why what is the returns. Okay, what's the returns? Okay, let's go to here. What is the returns for each of them? Any question? Are you all clear? If you're clear, type yes. Oh, it's total. So Chao Chin asked, is it same as STI ETF. Okay, so let's not confuse the index with the ETF. Okay, guys, the index is the index. The STI is an index. Okay, S&P is an index. Dow Jones is an index. Okay, the ETF is basically the passive managed fund for that index. So it's a fund that want to mimic the price of the index. Do you follow what I'm saying? Okay, like SPY is to follow the S&P 500 index. Okay, basically it's a passive managed fund. Okay, so in STI index, basically it's the 30 companies, bigger company in Singapore. Okay, like Dow Jones is also 30. Okay, so then we have different index. Okay, Nikkei, we have Topics, we have Hang Seng, we have so many type of index. Okay, basically the idea is to look at the temperature of the market. Okay, where is the temperature of the market right now? Okay, so let's take a look at the returns. Okay, right now I'm comparing the returns of the aggregate. What is it then? The aggregate bond index versus S&P 500 index. So I start from 1980s. I think 1980s will have enough cycle. Okay, so 1980s. This is the average return. Okay, 2%, 6%, 32%. Okay, 15%, 22%, 14%, 7%, minus 2%. So bonds usually don't have negative. Usually it's plus. Okay, and then we have the S&P 500 index. So the S&P 500 index, 32% minus 4%, 31%, and then what are the challenging period? We got minus 9%, minus 11%, minus 2%, and minus 22%. Okay, then we also have the crisis time, minus 37%. Okay, so this is the S&P index, and this is the difference. Okay, so if it's minus, meaning to say S&P outperform. Okay, if it's plus, that means the bond index outperform. Okay, not very clear. Okay, no choice. Okay, so let me give you the summary. Okay, the summary is like that. Okay, let me see whether I make it bigger. How to make it bigger? Okay, hang on. Okay, is it better for you? Why see? Teacher on demand. Okay, so meanwhile, which is a better reflection of the market? Good question. What is the better reflection of market? Okay, so you understand Dow Jones is not a good reflection of market. Dow Jones. Okay, Dow Jones is what we call a price weighted index. Okay, it's a price weighted index, and then for S&P 500 is a market cap weighted index. So what do you mean by different? What's the difference? Price weighted index means to say, I put it in Singapore context. Okay, Singapore context is the how heavy, how weighted, right, is the stock in the index is based on the price. You follow what I'm saying? It's based on, we're talking about Dow Jones. How weighted is it? More heavily weighted is based on the price of the stock. Do you follow what I'm saying? So the price of the stock is, let's say, $100 versus price of the stock is, let's say, $1. So if it's price weighted, what it means is, which is like Dow Jones, what it means is the $100 is more 100 times more weighted than the $1 one. Okay, which is not true. Do you follow what I'm saying? Because in actual case, we base it on market cap, because $100 company may issue very little shares. Okay, may issue very little shares, whereas a stock less $1, they issue a lot of shares. So market cap, right, is based on price multiplied by the shares. Do you follow what I'm saying? So it doesn't mean a company have the price, the dollar value of the stock is higher means it's a bigger cap stock. Do you follow what I'm saying? But when you talk about the Dow, right, it is like that, which is not true, right? Yes or no? Okay, which is not true. So better reflection will actually be the S&P index. Okay, the S&P index is based on the market cap. Okay, the market cap of the stock. Okay, they will calculate based on what is the market cap of the stock. Okay, so they use that to calculate. So it's in actual case is a better indication of the market. Okay, Ken. Okay, so any questions so far? No question type no. If it's good, can you type, give me a like, please? Desperate for like, okay? Give me a like if this is so far okay. Thank you. No question, huh? Okay, now let's move on. Okay, next part, right? Okay, so let's talk about the returns. Okay, the returns. Okay, the returns of the bond versus the returns of the S&P 500. So the return of the bonds, 35 years out of 39 years positive. Okay, 35 out of 39 years positive. The highest return is 32% in 1982. The lowest return is minus 2%. So you see that the bond, when they minus very little, because it's basically IOU. Okay, so it's very little. Okay, the average return, so they have a smoother curve, is about 7.67%. Okay, S&P index 31 years positive. Okay, out of 39 years. And please like. Okay, thank you. Wow, suddenly got 95 like. So I should ask you all to give me more like. Okay, so 31 out of 39, and then 37% returns in 1995, and then the lowest return. Wow, look at this lowest return, 37% minus 37% versus just now the bond return minus 2%. So the drawdown is a lot more. Yes or no? Okay, the drawdown is a lot more. Okay. However, the annual returns in 1980s is this is 7.62. This is 12%. Okay, I did some study just now. If you take back longer time frame, okay, if you take a longer time frame, it's still about 10 to 12%. Okay, if you take a longer time frame, it's still about 10 to 12%. Okay, so that is the thing. Okay, number of years that perform. Okay, bond outperform is 12 of 39 because bond is smoother. Okay, and the margin of performance and the average underperformance. Okay, this one is the comparing the two. Okay, so conclusion is like that. Okay, let me zoom smaller back. Zoom back. Okay, permit this. Okay, so the average returns is like that. So this is the takeaway. Okay, guys, this is the takeaway. The takeaway is since 1928, good long enough. Let's say until 2003, the average stock return is about 11%. Okay, since so many years. But the T-bill return is only 3.5%. So if you look at the absolute percentage, not much, okay, because maybe only like here maybe like 6%, okay, lesser the annual returns. But if you compound it, you all know what's compound interest, right? When you compound it, then it makes a lot of difference because your $100 you invest since 1928, right? If you invest in the stock market, it becomes $225,000. Okay. 225,000. Later I give you the link. Okay, all this is not for me one. Okay, but I'll try to simplify everything. Okay, and then if you were to invest in T-bill, $100. Hang on, $100 here, right, will be equals to only $1,900. If you invest in T-bonds, it's only $6,925. Can you all see the difference? 225,000 versus 6,009. Okay, 2025 versus the. However, T-bill always have positive return. All the 85 years positive. T-bonds is slightly lower. Okay, so then what is the conclusion, Colin? The conclusion is. Can you all see so far? Okay, where do I find this? Let me see. It's all on the website. So I will post up for you all here. Okay, here, okay, this is the website. Later I'll post out the link over there. Okay, so all the websites here. Okay, but I want to share with you all this thing. Okay, so what's the conclusion? Okay, what's the conclusion? The conclusion is like that. The conclusion is you can choose. Okay, this is from Vanguard. Okay, Vanguard is like ETF. Okay, you can choose whether you want income. That means you just very safe. Okay, I don't want risk. I want a smooth curve, and then I want to what is the return? Okay, so if you are very smooth, 100% fixed income, is 5% annually. This is 1926. Okay, since 1926. Okay, and then if you put in a bit of equity, okay, slightly your average return increases. Okay, the slightly return increases, so around 6%, about 6%. Then from there, this is all income. That means you have less in equity, more in income. So you have about 7%. Take note not only the returns, guys, also take note the number of years lost. Okay, number of years lost also. So this is out of the 94 years, 15 years was a loss. Okay, whereas let's say example you do a 10% equity, 12 out of the 94 years was lost. Okay. Vanguard is one of the cheapest, by the way. In terms of ETF, is one of the cheapest. Okay. Then we have balance. Okay. So you notice when we put in more equity, then the returns go up. But when you put in more equity, you have more years that lose money. Okay. Because there's some bad years. Okay, lose money. So here, 40% equity, 7%, 8%, 8%. So up to 60% is about 8%. Then you have the growth one. Okay, the growth one is 70-30, which is a very common percentage. 70-30, 60-40. A lot of fund manager they call managed fund. A lot of managed fund is about 60-40 or 70-30. Okay, so that is their returns, 90%, 80%. Okay, if you just use these returns, 80%, 90%, and then you compare with a managed fund by a fund manager, chances are a fund manager will lose out. Okay, why? Because the ETF, the fund manager basically just follow what the index is doing. Okay, but in an active managed fund, the person there will buy and sell based on his skill. Okay, and the assumption is like that. Through his skill of buying and selling shares, he can get better return than just fix the investment. We just track the index or track the fixed income. Okay, so in general, they cannot beat. Okay, the passive managed fund will win out. Okay, and then of course there are higher percentage returns here. But you also want to take note of the number of years of losses. Okay, so from here you can go to this website and then you can decide. Okay, what's the percentage of gain and loss? The takeaway is like that, guys. You get paid for volatility. Okay, if you have long enough horizon, you get paid for volatility. Okay, you can have very safe. Okay, you can be very safe. Then you have low return. You have very so-called risky. The risky is really up to you, because risky is when I need the money and then the year is down, then it's risky. Okay, but if you have long income, the horizon is long enough, then the risk reduce. Do you all follow what I'm saying? Okay, so I think the takeaway for you all is you don't need to be binary. You don't need to do 100% equity. You don't need to do 100% fixed income. You can do something by yourself. Okay, but I want to share with you one thing is the more structured it is, generally the more less returns you get. Okay, the less returns you get. Okay, so I want to share with you one last thing before I go. Okay, is why is it that the index, right, the S&P index will perform better? Okay, I shared with you all this before. Okay, I think I don't need to share here. Maybe just to go through the selection process. Okay, but let me go through this instead. Okay, why the index over time will outperform, right? It's like that. Okay, graduates, you will understand this, what we call a comparative. Okay, so is it true that the index really outperform bonds in real life? Maybe not. Okay, so what's happening? Why does it outperform? It's like that because we have the index here. So far, okay? Any question? No question? If you are clear, type yes, please. Then I can move on. Then we go into the index. So in general, okay, please go and do your research. I may share with you on this. It's just a Google way, okay? Please go and do a research, okay? So in general, ETF in general perform better than managed account. Okay, in the last few years, the managed account do better. The active fund manager do better. Okay, in the last few years, but I now show you a very simple way to beat that lah. Cannot. Okay, Fat O Red asked this one, right? So how do you actually beat that? Okay, in fact, right now stock selection becomes so much more important. Okay, compared to last time. Okay, and why? Okay, I share with you all why is it more important nowadays. Okay, nowadays, right? I shared few days ago, right? Is the stock selection become important is because it's like a feeding mechanism. Okay, a feeding mechanism. When a stock becomes go into the index fund have to buy the stock. Do you follow what I'm saying? Okay, let's say example, this is the list of stocks, right? This is a list of stocks here. Okay, and let's say a stock. Let's say this is Facebook, right? Facebook. Okay, let's slowly do. Okay, so S&P 500. Okay, the 500 stocks, right? Over here is the 500 biggest cap stock over here. Okay, by the way, if you all want to know what are the biggest cap or the blue chip stocks, right? You can go to this website. Okay, go to this website. I will post up the link over here. This will actually help you to rank already the biggest S&P stock, the market cap, the biggest company in the world. Okay, Microsoft trillion already, Apple, Amazon, all these are $1 trillion company. Okay, then from there, so you talk about blue chip, all these are the blue chips. Okay, these are the blue chip stocks. Okay, so right now let's come back to here. So let's say example we have the 500 stocks over here, and then let's say example Facebook is outside that list. Okay, and Facebook is an upcoming company, so it will eventually go into that list over here. Okay, because how they get ranked is because of price multiplied by number of shares. Okay, price of the stock multiplied by the share outstanding. Okay, so if the stock is going well and things like that, eventually the price will go inside here. So what happens when the price go into the S&P 500 is, you see, if you're index fund, right? You're index fund. Okay, and if the stock goes inside the index, you have so-called no choice but to buy the stock. Do you follow what I'm saying? Because your purpose, right, of the index fund is to follow what the S&P is doing, Do you follow what I'm saying? So it is like a feeding mechanism. It feeds itself. So if you go in, then more money will go and buy this stock. Okay. Similarly, let's say example, a stock is not doing well right now, right? And it can drop out of the list, right? So when it drop out of the list, then the index fund which previously hold this stock, right now have to go and sell this stock. Do you follow what I'm saying? Okay. So why the S&P go up over time is what S&P graduates talk about is comparative strength. Okay, because they keep the strong keep going back into the list, and then they fire the weak. The weak one, if the price drop, right? If the price drop, then eventually it'll be out of the list. So that is every quarter they have this committee that actually go through this list based on liquidity, based on market cap, and all these things, and then they keep refreshing this list. Okay, and that's the reason why over long period of time it is going up. Understand? So then the next thing is, can I do better? Okay, so in our graduate say, hey, you can actually look at the cream. What is the cream of the crop here? Okay, what is the cream here? Okay, so these are the cream of the stock. These are the cream over here. So these stocks over here are like the bluest blue chip. or the biggest market cap stock. Okay, so do take note of them, and if you look at them, they are company that have good business model, they are making money and things like that. Okay, versus you go and buy a penny stock. Yes or no? Okay, so Sharon asked, should you recalibrate? You can. Okay, so if you every quarter you can also recalibrate the stocks. Okay, you can keep your top 25, top 30 stocks, up to you. Okay, to look at the biggest cap stock. Okay, so let's say example, we were to look at okay, any question? So takeaway, guys, is why the S&P 500 is doing well is also because of this mechanism, and you get paid for volatility, and then you the risk, right? Risk is only risky if you don't have time. Do you follow what I'm saying? It's only risky if you don't have time, because just now you mentioned the index already, right? The index over here, the higher the percentage of equity, the higher the return. Yes or no? Okay, the higher percentage of return, the higher the returns. Okay, so but in real life, okay, if you really need the money, and that year is a down year, then jalat already lah, because you will end up losing money because you will cash out at a bad year. Okay, so another question is Kate asks is, will we like Nikkei? Okay, so Nikkei is very unique. Okay, so if you do some study to Nikkei, right? Nikkei is calibrated once a year. Okay, go and do some search. Okay, Nikkei is calibrated once a year, and they don't really use market cap as the way to do it. Okay, go and do some research on Nikkei. Okay, so if you want to use the topics, you can use the topics instead of the Nikkei. Okay, can index go bankrupt? World War III, if World War III, then all the company all zero. Do you follow what I'm saying? But because it's diversified, okay, so it will not, okay. But the way Nikkei is calculated, right, is different. Okay, it's different from how they calculate. I think I won't go into it, but you go and do some research, right? Nikkei is calculated based on not the usual way of calculated. It's based on go and research, okay? I don't go and do research, okay? Ken? Yeah. So next question is, I answered this before. What drives price to go up? Okay, there are a few factors. Number one is inflation. You see, our central bank keep printing money, right? Just inflation alone, let's say 3% a year, price go up over time. Yes, that's the first thing. Yes or no? Inflation. Second thing is why price go over time is business have system processes and things like that. You have this refresh mechanism process. If a company, let's say during the gold rush, I don't know where's the gold rush, right? Well, everybody was into the gold mining stocks, the railway stocks and things like that. Yeah, maybe they are in this list. But when the gold rush ended in US, right, then they will drop out this list. Like example, many years ago, ExxonMobil and things like that, they are the top, Do you all know that? In fact, during the peak, I forgot which year is it. I think it's 107 or something like that. The market cap, right, for the top 70% of the stocks are oil-related stocks. Oil-related stocks. Okay, right now, right, the oil-related stock, the market cap is only 5%. Okay, during the peak, the market cap for the oil is 70%. Is oil-related. Now, it's only like 5%. Okay. Now, let me ask you a question. Now, where is it heavy, the S&P index? Do you all know? Heavy on what? Tech, okay? Now it's very tech. You look at the list, right? Look at the list. Tech. Yes or no? It's very tech related. But many years ago, this list, that same S&P 500, right, was very heavy on oil. In fact, during that time, ExxonMobil, all this is like always the top. Do you follow what I'm saying? So through this, right, you can have this refreshing process. Got it? Okay, so it's more like a chit chat session. So we don't really have a objective. Do me this favor, if you like what we share, can you post, give me a like, okay? And if you can also share this post and share this post. I think some of you all share, but not a lot of you all share, okay? But I appreciate if you all share. 21 trading challenge. Okay, I'll answer your question in just a minute, okay? Actually, that's a topic for another day. It's enough to discuss this another day. Okay, so if you like this, you can share this post, and then other people can benefit from this. You learn more, doesn't other people learn more doesn't mean you have to learn less. Okay, everybody can benefit from this. Okay, so knowledge don't have monopoly. Okay, get this question. Let's answer next time, can? Because there's so many things we can talk about this. Okay, we can talk about the US debt, we can talk about the Fed printing money, and then when will all this end? Okay, on top of that, since when the S&P index suddenly shoot up? Okay, have y'all seen the S&P index? It's not like in the 60s, right? It's not so crazy. Okay, it's only nowadays the index became crazy. So if you look at the index over time, I hope I have long enough data. But in the 60s, in the 50s, let's look at the Dow. Look at the Dow, okay? So it was only after a certain period of time, right, that the market went crazy, okay? Okay, so let's take a look at month. Hopefully I got enough data. Okay, take a look at that, okay? This is the Dow Jones Index. Can you all see? The Dow Jones Index. You see, from the 1940s to 1970s, the index is between 143, and then the highest in 77 is 700. Do you follow what I'm saying? Okay, so it took like so many years, right? Let's say we start from 00, okay? From here, let's say 300 points, okay? Around 300 points. Dow Jones, right? 300 points in 1930s until, let's say, 1985. 30s to 85, 300 to 1002. Do you follow what I'm saying? And after 85, after 85 went crazy, okay? From 1002, it go to 10,000 within a short period of time. Okay, like 20 years, it went through crazy. And then right now it's even crazier. Okay, why is it so? There's a reason why. Okay, there's a reason why the market so many years is so flat, and then after that, after this period, it went crazier. Okay, the sort of question is it going to get crazier and crazier? Is it going to get higher and higher? So less than 10 years, 10 years can be 70s to 80s, right? It's almost like flat, no? 900 points, and then end of the year is 900 points, okay? This one, 10 years, 60s is about 600 points to it's about 100 points. Do you follow what I'm saying? But after that, now one day can move 100 points, okay? So why is that so? Maybe we cover it another day, okay? This can be an interesting topic also. Okay, in fact, most of us are scammed. Okay, if not, then thank you very much. Thanks for being here today. Actually, the whole stock market is also rigged. So, but when you're rigged, you also don't go in blindly. Okay, so hope that this will be useful. This is an interesting topic. Okay, I think graduates also will know about this. Okay. Graduates also know why is it the stock market 10 years? Okay, last time it's like that. Okay, 85 to 95 is like 1,000 to 3,000, and then from there it's like here it's like that. Okay, there is a reason why. Okay, there is a reason why. Okay, and it have to do with politics. It have to do with US. It have to do with a lot of things. Okay, even Illuminati, even like New World Order, things like that. Okay, but we can, if we have time, we can go through that. Okay, this will be interesting topic. Okay, because I don't think I even tell you, I don't even share with you even this with the graduates before. Okay, so hope this is useful. If it's useful, give thumbs up. Okay, give like. Okay, share the post, and then prepare, and then can talk about it in the future. Okay, see you. Bye.